All right. Yeah, welcome to our first session of stock market investing. I know some of us have been asking for this session, trying to ask questions and get to understand what what the market is all about. Uh, it's an interesting market, and like I used to say, the difference between gambling and investing in stock market is knowledge. If you don't have the knowledge of how the market works, you are as good as just a gambler. You are like doing bet Niger, you know. But when you have understanding, you can make educated and calculated moves uh, to position your portfolio and take advantage of the market, you know. So my goal is to help us to understand the nitty-gritty of the market to improve our fluency in stock market investing. So that when you even engage people or you listen to news or you are looking at your portfolio or you are looking at charts, you can have an understanding of what it means. It's not going to make you a professional trader. It's not going to make you a professional investor, but we're gonna have basics of what we can build on and we'll be able to become a better investor at the end of the day. So that's my goal and objective. And we can't cover stock market in one session. It's really not possible. But what I've committed to, or what I'm committed to, is taking a session every month at least to cover what we need to know. So hopefully, by the time we are done with session this year, we should all be grounded in stock market. We should all be grounded in fundamental analysis, technical analysis, sentimental analysis. Then from there, we can continue to build on areas that we feel that we still need more clarification and uh, more input. So this session is to create the general foundation. Some of the terminologies we'll be saying, what is the market and all that. So if you have any question, you can note it down. In order not to take much of our time, you can note it down, send it to me on WhatsApp. Then I will do my best to answer it in the main group so that other people can also learn. But you can send it to me, you can DM me with your question, from this session. All right. And if you need any clarification in the course of the training, maybe you can raise your hand. But I don't want us to slow down the session so that we can stay within the time that we have allotted for the session. We have a lot to cover, but I will try my best to make it snappy. The session is also being recorded so that we can all go back and listen, or for those that can't make it, they can take time to listen to it. So let me go into what we'll be covering today. So today, we'll be looking at 10 major things. The first is the stock market. What is the stock market all about? Why companies list their shares? We want to have an understanding of that. Then we look at who market participants are. Then we look at types of markets. Then after that, we look at type of stocks, growth stock, value stock, dividend stock, blue chip, and all that. Then we look at how money is made in the stock market. Then we look at major exchanges that we have. Then we look at the market indices. We're also going to look at bull and bear markets. What are they all about? Then we look at market behavior. Then lastly, we look at chart review. So we take one chart. Zenith, I've actually taken Zenith. So we're going to do high level review of Zenith. You know, then that will be all for today. So let me start with the first card, which is about stock market. So let's look at the journey of shares as a whole. How did we come about trading in shares? Who started the whole the whole stock exchange and shares and all that? So looking into history, we can see that uh, the old concept of trading in shares started from Amsterdam by a company named Dutch East India Company. The company goes to India to trade, to get materials, go for war, and all those things that the colonial master did during this period. And it requires them to fund this expensive voyage. It's usually an expensive uh, venture to go to the east, to the far east in India, and it can take them years. It takes a lot of resources, right? So, and it's when they eventually come back, it yields a lot of profit. So they came up with an idea. How do we share this risk? And how do we share the profit? So they came up with the idea of selling shares. That is a part of the voyage or a part of the venture that people that have money or the public can put money into. And when they come back, they share the profit to them. That is really the origin of the stock market. Then that's around 1602. Then we move to the period of 1600 and 1700s when in London, some group of people started, trading their shares in a company amongst themselves. They would just meet at coffee houses, just exchange this stuff. And from there, they gave birth to London Stock Exchange. Then around 1792, the United States stepped into the game. And with their Bretton Woods agreement, they came up with the New York Stock Exchange, where the public can now invest in financing projects like railroads, banks, factories, and in exchange, share part of the dividend and the profit, share part of the profit as dividend. Then we entered the Industrial Revolution around 1800 to 1900, where most companies are not take that as a standard way of raising fund, sharing risk, and sharing profit. Then with technology coming into play in the 19 and 2000s, then we have stock market everywhere. Now on our phone, on our computer, we can easily trade without having to go through brokers like we used to, or having a physical certificate as it used to be. So that's the journey of shares. It started from a group, from a company looking for how to raise money from the public, share the risk with the public, and share the profit, then into becoming a gold standard for companies and into becoming something that is accessible to all of us as retail investors. So that's the journey. In case anybody asks you how we started all this stock exchange stuff. Right. So let's look at what stock market is all about. So stock market is a public marketplace. Think of it like a normal market. We go to the neighborhood market to buy tomato, to buy oranges, to buy all manner of products we have in the in the uh, in the public market. Same thing with stock market. It's a market. So if it's a market, there will be buyers and there will be sellers. Someone will offer something and somebody must will want to buy something. And when you have a buyer and a seller, then definitely there must be a price on that product. And the price is not subject to negotiation. You don't just walk into a neighborhood market and the woman tells you that this is how much my tuber of yam goes for. You will naturally want to price it, right? You want to price it. So that is what stock market is. We have the buyers, we have the sellers. They are trading shares, which is a representation of ownership in a company. And in order to do that, we have platforms that help us to manage or formalize this transaction. That's where stock exchanges come into play. They help to ensure some form of formality, orderliness, and legality to the transaction we are doing. If there's no legality to the transaction we are doing, it's going to be seen as a black market, right? So, um, so that is what essentially stock market is all about. For example, if you contrast it with the kind of pyramid schemes that we've all seen in Nigeria, the MMM and the rest, what is the difference between MMM and stock market? It's just that the MMM and the likes of pyramid scheme, one, they are not regulated. So nobody is actually formalizing that transaction. So they can easily take advantage of people. There's no way to protect against counterparty risk. So because of that, it becomes illegal in itself. And we have seen it play out time and time over where people lose their money when the players or the participants decide to fold shop and close. But stock market is not like that. Stock market is regulated, it's controlled, and it's legal. So the fear that people we have when they are investing in pyramid scheme is not the same fear you have in stock market. Stock market, I don't need to cohort you to join stock market for us to be able to make profit. As long as we have companies that are trading, that are doing legitimate business, then we can be part of the ownership. So trading can also occur over the counter. There's some large volume of trade um, that you cannot execute on exchanges. So for example, let's assume that I want to buy 30 million shares of Zenith. And in a given day, maybe the total volume that people want to trade is 15 million. So where will I get the remaining 15 million? Even if I'm mopping up from everybody, you know. So those kind of deals are done over the counter. They are done by dealers, people representing those companies or those individuals. They will negotiate it. They will negotiate it. You will not even be there. You will not even know about it. That's why you see some of the posts that have been forwarding. They say so stock cross at so price, right? So people are doing transaction at a particular price point. They will negotiate that, but that can also give the direction of where the market is going. So I just need to mention that we have over the counter trade. Then stock markets generally help us to grow wealth and company to access capital. You know, so let's look at why companies list their shares. The first reason why they will list shares is to grow, raise capital for growth, right? Is to raise capital for growth. Um, if you start your business with your personal capital, you will get to a point where you cannot scale again, except you borrow money from the bank or you look for other ways of raising funds. People have used families and friends, they've used cooperative, they've used bank. But one of the cheapest ways of raising funds for business is to just share part of the profit with other people. There are some people that have capital, uh, they have money, but they are ready to invest their money, but they don't have interest in running the business per se. So they can give you their money, you run the business, and you share the return. But now imagine a company like Zenith Bank. Let me use my Zenith for example. How many people will they approach to collect money from them? You know, how many houses will they visit? That please, I need want to open a branch in Uganda. Please, do you have money that you can borrow us? Absolutely, they can approach everyone. So there has to be a way for them to raise money, and that is where stock market comes into play. So they will have to sell their part of their shares. We call it outstanding shares. When we get to fundamental analysis, you get used to some of these terminologies. So they have to decide how they want to break the company down into shares, right? And decide how much of that share they want to offer to the public. It's not all the shares that they offer to the public. So how much of those shares do they want to offer to the public, and how much is it going to be priced for based on what they need the capital for? So companies sell shares to raise capital. Now, the next reason why they sell shares is to increase their visibility and credibility. Now, uh, listed companies are seen as reputable companies because if you don't get your acts together, if you don't have your books straight, right, nobody will want to buy your shares. So coming to the public tells us that you have grown to the level that you want to show some transparency, you want to show some accountability, and that breeds credibility in your business. So I will be inclined to want to bank more with Zenith because I've seen their level of credibility. I've seen their book. Once you come to the stock market, you have to open your book. If you don't come to the stock market, you can decide to keep your book. Nobody's going to force you to open your book, right? People have been asking questions as to what's happening with some companies in Nigeria and all that, but you can't know until they open their book, right? So coming to the stock market shows that at least those companies are trying to demonstrate some level of visibility and credibility. The next reason why they're going to list their shares is to provide liquidity for investors, right? Shares of listed companies can easily be bought and sold by investors, right? So you provide liquidity, they can breed confidence in your business. So if I see that people are buying your shares and selling your shares, it can help build confidence in your business. Also, it offers exit route for early investors. Like you said, if a company wants to scale up, it will need more money. Now, most times before they come to the public, they must have approached some private individuals, those that they know have money of capacity to invest. That is what we call private placement, right? At that time, you don't even know about what is happening in that company. It's just some few people that have money that will be approached or approached through investment houses that invest. And these are people that actually first benefit from a stock going public because they can exit. So imagine those that invested in MTN when MTN just came and gave them money to do business, maybe at 20 naira per share or 30 naira per share. You know, when MTN went public at almost 200 naira, they will cash out. They will sell some of their investment and move on to another business. So it provides an exit route for people, for early investors. And lastly, it's also to meet growth milestones, right? Like I said, it helps them shows transparency and regulatory oversight. So that's why we list stock. It's just to raise money and to show that our businesses are matured and are transparent. So let's now look at who are the market participants. You know, there are different kind of people in the markets. So where do you sit? There are other people. Who are they? So the first group of people are the retail investors. You and I, we are retail investors. We are just buying in bits, in trickles, buying in parts, some small volumes. You want to buy 5,000 naira shares, you want to buy 1 million naira shares. We are just retail investors. We are like retail traders. You know, Going to using the example of our neighborhood market, we are like those general customers that walk into the market to buy tomato, to buy apple, to buy all the. So we are retail investors, right? But the good thing with that is that we are part of the people that provide liquidity to the market. So when I see more people venturing into stock market investing, it shows me that we are having more liquidity. You know, unlike the um, unlike the pyramid schemes that we have seen where people will have to look for somebody to join their group before they can move up. Stock market is not like that because you have many retail investors coming in, going out. By itself, it provides liquidity, right? And diversity. But aside the retail investor, we have those we call institutional investors. These are pension funds, insurance company, mutual funds, hedge funds, sovereign wealth funds, banks. These are people that have large sum of money to invest. They are not investing 5,000 naira, they are investing in millions and in dollars, you know. And these people, they move the market, right? They move the market. When they buy in bulk, they buy in volume, and that volume can set the direction of the market. And when they sell to or dump their stock, you know, they can send the market in a downward trend as well. So they have large investors, right? So you wonder sometimes when you place um, a bid to sell your stock, and it appears as if you're on full bid, and somehow they still get we still were able to sell your stock. It's because there are still other people behind the scene that are buying and selling, that you might not see in your open chat, you know. So we have those big players behind the scene. Then we have brokers and dealers. These are the people that we deal with, the Meristem of this world, the Morgan Capital of this world, and all those brokers that we buy through them. The difference between a broker and a dealer is that brokers serve as intermediary, while dealers deal directly by himself. But many of the agencies that we use, they do both. They also deal by buying and selling, and also serve as intermediary for us and collect commission on trade. So when you are joining or when you are registering with a broker, you want to know what is their commission like, because commission for some broker can be very expensive and can wipe out all your gains, especially if you are trading at a low volume. Then we have listed companies. That's what they call the issuers. So when you are buying IPO, you hear them talking about the issuing houses and the issuers. So the issuers are the companies that actually wants to sell the IPO. The issuing house are the ones that are representing them, packaging the deal, you know. And they are also very important because they are the one that creates the product we want to buy in the first place. Then we have regulators. So we have two main regulators in Nigeria. We have the SEC and we have the NGX. In US, we have the SEC and the FCA in UK. But in Nigeria, we have two main regulators, the SEC and we have the Nigerian Exchange Group, and their whole objective is to enforce the laws, to protect investors, to ensure companies disclose accurate information and maintain market integrity. Without them, companies don't have the incentive to want to tell us the truth about their book. But with them, they ensure that the information that they are putting out there are at least accurate, or also have the confidence in the market. And six, we have market analysts and advisors. You see agencies like Nairametrics and some other individuals that analyze the market. Even the media houses, the channels news and all that, you listen to different analysts, different advisors. Their own job is to provide information to us about the market to help with our decision making. Then we have the market makers rather. Those are companies or individuals that are large volume to sell or to buy. They also try to provide some stability and liquidity in the market. There will not be any time where there will not be something to sell or buy in the market. Because if everybody just buys and walk away, then the market will not be efficient. So there are some people that will maintain the minimum, some flow of liquidity in the market, So that's what they do. They will really always look for discounts, uh, prices and sell and buy and all that. Then we have the clearing and settlement institution. So in Nigeria, we have the CSCS, the Central Security Clearing System. Like I put here, it is a market infrastructure, not a rule-making authority. What that means is that they are not like NGX or SEC. Their job is to provide a platform or a system where we can record the shares that we buy, who owns what, at what price was it traded, and ensure that there is no risk to the other party. So when you register with your broker, some broker will give you stock transfer form to sign. Every time you buy stock or you sell, they have to execute that exchange between the buyer and the seller. You don't know because you just put it on your portal, on your platform, and walk away. But behind the scene, they have to ensure that your shares is properly transferred to the new owner, and the money that you have paid is paid to whoever the buyer or the seller is. So they ensure that happens behind the scene. So they are part of the market participants, and they ensure that all trades are completed safely and correctly. Now, let's look at clearinghouse number and trading numbers. I know we are familiar with these. You must have been hearing my CHN number, my CSCS number, or trading number. What does it mean? Or the CHN number, which is the clearinghouse number, is like your BVN. If we bring it into banking context, it's like a BVN. you're actually supposed to have one CHN as an investor for life, even though in reality, we tend to have more than one CHN because when we are registering, we provide a different details and each broker will want to open a new account. Imagine you opening with one email with one broker and opening with another email with another broker. They're going to see you as two separate individuals, right? Otherwise, once you have a CHN number, which is your clearinghouse number, you can tell the next broker that you already have a CHN number, use my CHN number. So you don't have to be having new CHN number if you change your broker, right? So that is the purpose of CHN number. It's your investor identity card. Your identification number in the stock market, on the capital market, is your CHN number. Just like you have your BVN in your in the banking sense. If you go to Access Bank, your BVN is your BVN. If you go to Zenith Bank, your BVN is your BVN. Same thing with CHN. Then the next number you now have is your CSCS number, or what we call trading number. That's like your bank account. You can have many trading accounts with many brokers. Each broker will give you a trading number, which is like your account number with them. But you can or should only have one CHN number. So when you're opening with another broker, you can tell them that you already have a CHN number. Use my CHN number. Well, you're going to have a new trading number with them. If you don't tell them, they will likely open another CHN number for you. You know, so you're now going to be having different identities in the stock market. All right. So that's what your trading number is all about. And we know how to check our CHN number. If you go to your portal and you check your details or you check your account statement, you will see your CHN number there and your CSCA or your trading. Sometimes they don't call it CSCS, they just call it trading number. You see there, if you go on CSCS portal and you provide your BVN number, it's also going to fetch out your CHN number. And if you already have multiple CSCS account, you can ask them to, or trading account, you can ask CSCS to link them up. So I did that at some point because I had my account with a particular broker years ago. Then I opened with another broker. So at some point, I wrote the CSCS that I want to merge my stock in with this old broker with this new broker. So I match them together, right? So they will do that for you, right? If you send them all the details and information. But it's best to avoid having duplicate CHN number. Right. So when you're opening new accounts, just ensure that you provide your existing CHN number to them. So we have two types of markets. We have the primary market and we have the secondary market. The primary market is the market where the stock is sold first hand. So I call it goods from the factory. While the secondary market is second hand market. It's like buying Tokomo. So when companies offer their shares to the public through IPO, initial public offer, the money from that IPO goes to the company. That is the only thing they benefit. It goes to the company. After that, once they issue me or allocate my share to me, I am free to go to the second-hand market, which is the secondary market, to sell it to whoever I want. And that is the beauty of stock exchange. It's because I know I will be able to sell down my share or my ownership in that company to somebody else when I need money. That is what will give me the confidence in buying their IPO in the first instance. If there's no well-regulated market where I can sell, then I will not want to buy it. Let me give an example. People buy Toyota vehicle. Why? Because they usually claim that it has second-hand value. That means when I want to sell it and I need money, I will still be able to sell it at a fair price to someone else who can continue to use it. So if it's a vehicle that does not have a second-hand value, you don't want to even buy it in the first instance. So same thing with the market. Companies that you believe that they have good track record, they've been operating for a while, and now they want to sell their IPO. People will tend to want to buy it because they know when time comes, they can go to the second-hand market, which is the secondary market, where all of us play as retail investor and sell it. So in the secondary market is the existing shares that we are trading amongst ourselves, not with the company again. The company does not get anything from it again. You know. So this is the first question that bothered me some years back. So what is the whole purpose of having selling shares as a company if I will see the price going up and there's no benefit to me, even though they have other ways of getting part of the benefit? But the most important benefit to them is one, it helps other investors to be able to evaluate their company, so we can know what does the company worth, because what we are trading amongst ourselves is a function of our faith in that organization. For Zenith price to go as high as it has gone shows that a group of us have faith inside them. We have faith in them. We believe in what they are doing and that they are running the organization well. That is what it means. So that way, if tomorrow Zenith wants to raise more money through right issue or another public offering, they know where to set their value. They know where to set their price. That's the benefit. Otherwise, what we are selling amongst ourselves every day does not go to them. It's only an exchange of value between you as either the buyer or seller and the other party. So that's the secondary market. So most of us are playing in the secondary market. It's only when they sell IPO to us or they sell right issue to us that we say, okay, we are venturing into the primary market at that point. Now, type of stock, type of stock. So we have different types of stock. Please confirm you can still hear me.
Yes.
All right, I just want to be sure. All right, thank you. So we have different types of stock. The first stock or the first type is what we call the growth stock. These are companies that are growing very fast. Profit are rising quickly. Share prices can increase rapidly. You know, like I put there, it's often found in tech companies or new industries. And lately we've been seeing some companies like TIP, quite a number of small, fast growth stocks. Those are growth stocks. We have value stocks. Those are stocks that looks cheap and undervalued. There are some stocks that when you look at what their price is and the fundamentals of those companies, you can say that this thing is cheap. If you go to a market to buy something and you look at the quality of that stuff, and you look at the price they put on it, you yourself you can tell you that this thing is very cheap. You know, not everything that is cheap is good, but where you have proven that this thing is quality and the price, perhaps maybe the seller does not know that the price should be more than that. Maybe the seller just kept the price for whatever reason, but you can know that this thing is undervalued. You know, those are value stocks. Then we have dividend stocks. These are stocks or companies that pay part of their profit to shareholders regularly. Some don't pay regularly. Some will pay this year and not pay for the next 2 years and pay again. You will see it in their dividend profile, irregular payment. But there are some that they will pay consistently. Some might pay very high this year and not pay next year. So while you are clapping for them this year, you might not get anything next year. But some might not pay that high, but they make sure that they maintain consistency. Every year, something will always drop from their profit. Those are dividend stocks. Then we have blue chip stocks. Those are large companies that are very well established and strong. They've proven their track record over years. Their market capitalization is very solid. They also often pay dividend and they have lower risk. Then we have penny stocks. Those are very cheap stocks, usually small and struggling companies. So in Nigeria, we say any stock that's below 5 naira is seen as penny stock, and globally they use $5 as a benchmark. So if your stock is 2 naira, 1 naira, 1 naira 50 kobo, 99 kobo, those are penny stocks. They have not proven that they have the capacity to do well, but they may do well. So if you take a risk on them and buy them in bulk, you may make money when they eventually turn the company around. But you just have to understand that there are different types of stocks. Your approach to investing in each stock would be different. So if a stock is a blue chip stock that is also a dividend stock and as a value stock, your approach at investing in it will be different from when you are looking at a penny stock or a growth stock, right? So it's important for you to be able to determine what type of stocks are you considering or are you looking at? Is it a value stock? Is it a dividend stock? How do you want to position your portfolio? Do you want to tilt it more towards growth stock or penny stock or towards dividend or blue stock or towards dividend and value stock? Those are personal differences, you know. Then how is money made? How do we make money in the stock market? Two ways, capital gains or dividend. Is either we buy low and sell when it's very high, or we collect part of the profit that is shared as dividend at the end of the day, or a combination of both. Some companies will provide capital gains in the sense that their shares price will improve, will grow over time. They will still give you dividend. Zenith is an example of that. That's constantly been paying dividends since 2000 and I think 2006. There's no year Zenith has not paid dividends since 2006. Even when you add a recession, Zenith will still pay you dividend. you know, and they've also grown from 6 naira or 10 naira to almost 110 naira over time. So those are blue chip, solid dividend companies. You know, so our approach might also be different when we're investing. Some are only interested in capital gains, especially when you don't have uh, huge capital outlay to be able to command substantial dividend. You might want to focus on capital gain. But if you have enough capital, you might want to play the dividend game and you might want to do a combination of both. It depends on what your objective is. So I always encourage people to set your objective at the beginning of the year. What do you want? I do more of dividend. I'd say 98% or 97% of my portfolio is linked towards dividend. But those dividend stock also provide capital growth, right? But I have about 2 or 3% that I play around with in terms of penny stock or growth stock that I want to use to gain some mileage. And so that's also important to note. Now, talking about exchanges, I've said that exchanges those are places where we sell our product and they help regulate the transaction between the buyer and the sellers. And we have the top four in Africa, just for our knowledge and understanding. The first is Johannesburg Stock Exchange, that is over $1 trillion. The second in terms of value is Morocco, that's Casablanca Stock Exchange in Morocco. It's about $70 billion. The third is the Botswana Stock Exchange, that's about $53 billion. And the fourth in Africa is Nigeria Stock Exchange, which is about $50 billion. I must say here that the Botswana Stock Exchange don't have or doesn't have as many companies as Nigeria Stock Exchange. But the companies that are listed there have more value in terms of they are in the mining sector, the gold sector, and all that. So in terms of value, they have more value. And also Nigerian Stock Exchange depends on our exchange rate. Sometimes we match up to Botswana at 53, $55 billion. Sometimes we fall back. But for representation sake, uh, Botswana Stock Exchange is like in third position, while Nigeria Stock Exchange is in fourth position in Africa. Now, when you look at the global market, of course, New York Stock Exchange is the biggest or the largest in the world, you know, and they determine the world's financial stage, right? Then we have the NASDAQ. You might have been hearing about NASDAQ. NASDAQ simply means Nationalization of Security Dealers and Automated Quotations. It's like an exchange that is set up for tech companies, you know, especially small companies that are just coming up. They might not be able to play at the level of companies in the New York Stock Exchange. So they created another platform, actually online platform or electronic platform where those stocks can be traded directly, but has grown to become a bigger global technology market for the world. Then the third is the Shanghai Stock Exchange, which is in China, and we have the Tokyo Stock Exchange, which is in Japan. So an average investor should have this knowledge. Like I said, is to improve our fluency. So you should be able to know the top exchanges globally and in Africa. So let's go to market indices. Let's go to market indices. A market index is like a scorecard. It's like a scoreboard. It's like going to a stadium and watching the scoreboard to know what the goal line is. That's what a market index is. It is where we see the performance of a particular stock market. So in Nigeria, there is what we call the NGX All Share Index. All right. It measures the entire Nigerian stock market. It looks at all the companies um, on our stock exchange, look at their performance, and come up with an average number to measure the overall market performance, right? So if the index goes up, it means that the market generally overall is doing well. It doesn't mean that some of the companies in your portfolio will be doing well. They might be doing poorly, but in totality, the market is doing well when it goes up. And when it goes down, it means that the market is struggling. So that's what we look at as a whole to describe how Nigerian stock market or any stock market is performing. So in US, we have what we call the S&P, the Standard and Poor 500. That's looking at the 500 biggest companies in US in terms of market capitalization. And they have another index they call the Dow Jones. So if you are listening to news and you hear the Dow Jones is just looking at the top large companies in US by price. So the difference between S&P 500 and the Dow Jones is that S&P 500 is looking at the value of the company in terms of market capitalization. It looks at their outstanding shares with their price and arrange them according to the biggest to the lowest, and pick the first 500 into a bucket and track their performance as an index. But Dow Jones is not concerned about your market capitalization. It's concerned about the price of your shares. So it arranges them from the highest price to the lowest and select the first 30 and put them together into a basket and measure their performance as an index. Nigerian stock measures everything in the stock markets. We are not arranging them by capitalization or price. We measure them together as a whole to describe our stock exchange. When US, you will often hear of S&P 500, Dow Jones Industrial Average. Those are indices that show you how market is performing and the state of the economy. So next time when you listen to channels business news and they mention S&P 500, Dow Jones, Nigeria All Share Index, you have an idea of what they're trying to uh, say. So last week while I was preparing this slide, I was listening to channels business news and the anchor said Nigeria All Share Index ASI crossed 200,000. So I felt it's important to bring it into our discussion. What do they mean by we have crossed 200,000? What is 200,000? Who said the 200,000, right? So as I said, All Share Index is a measure of the performance of our stock market. It shows that investors are buying more. You know, these numbers called 200,000 is not determined by anybody. There's no agency that is saying this 200,000. It's from the charts that they begin to see the new eye that this Nigerian stock market as a whole is measuring. When we get into technical analysis, you begin to see some of these things. And so we have the 50,000 point, the 100,000 point, the 170,000 point, the 200,000 point. It simply just shows that the market is going up. And at every point in time, is outperforming its previous highs. So if its highs before was 50,000 and it's getting to 100,000, it shows that we are in a sort of upward trend. So what it means, one, is that we have a record-breaking market performance this year. We are currently sitting at 200,000 mark. It shows that there is strong investor confidence in Nigerian market. So the market is, people are buying it aggressively. We have more retail investors coming in. We have more institutional and foreign investors also coming in. Then we have higher valuation for listed companies. That means our companies are getting higher valuations. They are becoming more valuable. Their performance is increasing as a whole. So anytime you hear that all share index has crossed, that means if they said it has dropped, that means we are going in the reverse direction. So it's one index you want to watch out for in the news. So how do you interpret index milestone as an investor? First, it signals broad market strength. So when it's going up, you know the direction of the market. And when it's coming down, you know what might likely happen. So it also reflects economic expectation. When it's going up, it shows that corporate profit will grow. That means companies are likely going to be declaring a good profit. And when it's coming down, that means companies might likely be declaring loss. It also shows government policy that they are supportive of the market when it's going up, and when it's coming down, it shows that it's the other way around. It also shows momentum uh, and the direction and the momentum, which attracts more investors. Now, it can also signal overeating. Overeating means that, um, yes, the market is growing up, it's going up and it's growing, but it can lead to speculation. People can now start to want to game the system. That's what happened in 2008, when people go to borrow money from banks to buy stock, wanting to sell it to pay back their loan. They now became speculators. People were no longer looking at fundamentals, they were speculating. And because of that, when crash happened, many people lost their money. So one also have to be very cautious when you see all share index going up. It can signal speculation. It can lead to correction. It can also tell you that there will be correction at some point. Correction means that things will naturally stabilize back or come back down. You cannot go high. Things will not be going high forever. There will be a time that there will be correction. It will come down. It will come down, it will stabilize, then go back up again. That's the way life is. There's nobody that grow forever in one direction. You will grow old and start to come down. That is the natural bear curve. So we get to see more of this when we are doing technical analysis. Then also help us judge our portfolio performance. So if the market is performing at say 20% average for the year and your portfolio is doing 10%, that means what you have in your basket, in your portfolio, are not measuring up to the market. So you might want to look at the kind of companies you are holding and reshuffle your portfolio. And if you are doing 30% and the market is doing 20%, that means you are outperforming. That means you are even smarter than the market. So it gives you a kind of reference line to judge whether your portfolio is performing well or not. And it helps you to adjust your strategy. Those are the way you interpret index. When you see an index, you want to know where is my portfolio, what is my portfolio doing relative to the all share index, and determine when if you have to adjust it. Right, bull and bear market. We should be rounding up soon. Bull and bear market. I tried to look up the story or the history of how they came about the bull and bear, you know, out of curiosity. But there is no defined, agreed uh, historical point when bull and bear became an indicator for the market. But the bottom line is that the bull signifies uh, that the price is rising and investors are feeling confident in the market, while the bear is pushing the price down. That means the market is falling and is entering into a depression state. So it's also an indication of the economy as a whole. So when you hear the bull market, it simply means that stock prices are going up, investors are optimistic, companies are reporting strong profit, and economic condition looks good. And that means it feels good to invest in such market, right? And when you hear the bear market, that means your stock or any individual stock or share index has dropped about 20% in terms of their price from their previous highs. Investors are pessimistic, the economic news is negative, and companies are struggling. You can also have uh, uh, when you listen to stock market report on the news, they will always say whether the bull is winning today or the bear is winning. It simply means that the market, at the end of the market, overall stock prices increase or reduces. That is the bear market. If it reduces, if it increases, that is the bull market. So you will be hearing bull and bear, bull and bear. It simply means optimistic and pessimistic positions. All right. So market cycles. Markets moves in a cycle. We have the expansion, we have the peak, we have the contraction, and we have the trough. Everything in life moves in a cycle. you know, the economy also moves in that cycle. Your stock and portfolio will move in that cycle. So it's not going to be expanding forever. It's going to peak at some point. It's going to even contract, then it's going to peak again. So the question is, what should you do at those in those phases, right? So bull market, we've talked about bull market, we've talked about bear market. So how do you use those economic indicators, to shape, economic to shape the market cycles and all that, or how do they shape the market cycles? So when you listen to news, the first thing you want to pay attention to is the interest rate. As an investor, you must pay attention to the interest rate. I think it's quarterly that the CBN decide on what the monetary um, rates are going to be, which will translate to what the rate will be in the bank. So as an investor, you need to understand the implication of interest rate. When central bank raises interest rate, it means that borrowing money will become expensive. And when borrowing money becomes more expensive, market will react and market might fall, might shrink. Why will market shrink? You know, because now the cost of your goods will increase, the the product will increase, revenue might take some hit or profit might take some hit. Companies might sell part of people might sell part of their shares to recoup some capital to do the business. So the market will fall when the interest rate rises. And when CBN or bank cut rates, the money becomes cheaper. People have more incentive to borrow more money, and the market will rise because when you borrow more money, is that you use it to buy more stock or use it to run your business to make more money and all that. So the market will rise. So having an understanding of the interest rate will determine what the market cycle will be and what your portfolio will likely be doing. Also, inflation. High inflation reduces purchasing power, which hurts profit. When people cannot buy because of high prices, it's going to affect those companies and it's going to push their stock down. And when inflation moderates or reduces, it will support growth because more people can now trade and buy. So you want to pay attention to what the inflation is doing. Employment also can signal the direction of the market. But in Nigeria, where unemployment is already very high, you might not be able to get immediate signal from the level of employment in the country. Corporate earnings is another thing that we signal the direction of the market. When earnings are very strong, when companies are posting good profit, their prices will go up. Sometimes when prices are going up, is an indication that the company might announce good corporate earnings. So you can use that as a leading indicator, right? And when corporate earnings are weak, the prices are going to fall. Then investor sentiments generally optimism first boosts market. So when foreign investors especially, are very optimistic on our market, it drives the price up. So that's how you look at some of these economic indicators that shape the market cycle and use it to analyze your portfolio or the general market. Um, so Nigeria at the moment, like I said, we are currently our Ocean index is sitting at 200,000. We've moved from 70 to 100 to 150 to 70. So we are currently at the bull market stage. So the market is good. We want to buy now. Even though we are cautiously approaching a peak. So at some point it's going to peak and there will be some correction. Correction means that it's going to drop. So what you see as value now, as increase now, at some point it's going to dip. But now, if it dips, it shows that you can buy more because if it has attained that height before, definitely it will try to go back there, right? So it's also presents an opportunity for us to buy more. Now, let's go to the last part of this presentation before we call it a day, and that is stock chart review. I've chosen Zenith charts for high-level review. This is just to start warming up towards how to review charts. When we get to technical analysis, it's going to be a different ball game. So, and let me say at this point that you will need to have the following apps. One, UCharts. UCharts gives you a good view of the market. So download it and use it to also track your investment or your portfolio. You, it's good for you to also have Simply Wall Street. Simply Wall Street will also provide you with some fundamental information and details about your stock, and also have investing.com. Investing.com will give you some information around the technical analysis. So on your screen, on the screen, I have three charts. On the left side, I have uh, a chart from investing.com, Zenith. And on the right hand side, I have chart from Simply Wall Street. So let me take it. The first one at the top is showing trend. It's showing the trend of Zenith. Can you see my cursor? Indicate if you can see my cursor moving on the screen.
Yes.
All right. So if you look at this Zenith, this chart is simply showing you a trend. It's showing the direction Zenith is going. I zoom it to start from November last year. Somewhere here is November last year. See November, December, 2026, January, February. I can zoom it to 5 years. I can zoom it to 10 years, right? On this chart. So I zoom it just to 6 years. So when you are looking at a chart, the first thing you want to do is step back, zoom it back, and look at what is the direction this share is going in the last 1 year, last 5 years. Is it flat? Is it moving up? Is it moving down? It gives you some sense of what the company is doing, their productivity and improvement over time. So if I zoom out on Zenith, you will see how Zenith has been growing over the years when they come down and when they peak again. So, but I'm going to concentrate on November till March 18 or thereabout. If you look at this point where I put my cursor, Zenith dipped, right? Yeah, right? There was a dip in Zenith. Yeah, that was November, around middle of November last year, around November 13. That was when it went as low as 54 naira, right? Then after that, it quickly picked up again. You see it picked up here and it came down again. Then was there for a while up to December, around December, then it moved up again. Then it came down again. Then it moved up again. Then it remained flat. Then moved up again. Then came down a bit, remain flat a bit, move up again. So what you see in the performance of Zenith is that it's gradually moving up and correcting itself on the way. It's like climbing staircase, climbing 2 steps, coming down 1 step, climbing 3 steps, coming down 2 steps. It's like a corrective. It's taking natural corrective measures as it's going up. At those points, those are some of the points where people also take their profit. When people take profit, it will come down. Then some new set of people will come in again and it will move on. So when you are looking at it as an investor, you want to look at what is the direction of Zenith over the past 1 month, over the past 1 week, over the past 1 year, over the past 5 years. Then you can have an idea whether they are doing well and they are going up, right? So you see that the low that they had here, they've not had such low since November again. They had a small low here. The next low is higher and keeps higher. That shows upward trend. But if you look at the chart below it, this chart is essentially showing the same thing in different ways. This chart is what we call a candlestick chart. Candlestick chart is showing you at what price are people buying, closing and opening. When a price closes higher than its opening, that is green. You see it's green here, right? When you see this red candle, that means the price closes lower than it opens. The graph on top is showing you the trend, just showing the direction. But the one below is showing you more than direction. It's showing you what I call the magnitude. That is to what extent, what is the price like? You know, if you look at this place, where I put my cursor, where you have 111, you see that there's a green, something like a small hammer standing here, right? So you see it has a little tail, which we call wick. When we get to technical analysis, we're going to dissect this thing better. This wick, it shows that the price is still wanting to go up. The price is still wanting to go up, right? So these two charts are telling you the same thing, but with different level of information and details. Then you also see another small line, small chart that goes red bar like histogram. red and green bar is showing you the volume. How much are people buying at a particular point in time and how much are they selling at a particular point in time? It gives you some consideration. When you look at the chart on the right hand side here, the one with the black background, this one from Simple Wall Street is showing you the fair value of Zenith. Some analysts have projected that Zenith is supposed to be around 72 naira. That's their fair value, right? But currently the share is under 11 naira, which means it's beating analysts' projection. Analysts may be wrong. They made their projection using different modeling tools, to determine where the price is going. They may be wrong, they may be right, right? So, but that shows you, that gives you an idea of what the outstanding shares is currently doing. Is even beating all the market expectation. But it also does mean that it might correct itself and come back from its high of 111 towards 72, if the analysts are correct. So if that happens, assuming that it comes towards 72, some people might be scared and want to quickly sell. The more they are selling, the more it will be getting towards 72. And that's when some people will buy. Because if a share has proven consistently to grow over time and it could get to 111, if it ever comes to 72, it means that we always go back to 111. And that gives you an opportunity to quickly buy before it goes back to 111. Um, let me share an experience with one of us that happened last week. Uh, we made a move. We made a move around November here when the stock fell. Before then, he entered around 69. Then the stock fell somewhere here. So I requested that, okay, part of the share be sold, keep the money, move it into Bagger. Then he kept the remaining shares, right? The individual actually needed money, so that money has been kept. I said, okay, let's take a risk, let's put it in Zenith, and let's see what happens. I believe that even if Zenith drops to 54, right, it's going to come back up because I've been watching Zenith over time, their performance, and we did exactly that, and Zenith grew up to this 111. So on Friday, the individual decided to, we had some discussion and said, okay, let's remove the capital. And he was able to sell at 100 and I think 108, 110 naira. And that within space of this is November to March, he was able to remove his capital and still have more shares in Zenith than he started with, right? So this is where looking at charts becomes interesting, right? You can see how a stock is performing. You can see where you want to enter. You can see where you want to enter, and you can see where you want to sell or where people are selling, right? So we will do more of chart analysis when we get to technical. This is just to give you an idea of high level chart review. You can take any stock, go to investing.com, take any Nigerian stock and back out on 1 year, back out on 6 months, back out on 5 years, and look at the direction of the stock and start to look for their lows. Look for where the lows are. Are the recent lows higher than the previous lows? That shows upward movement. Okay, what is the volume that was sold when it was low, and when it was high, what is the volume that was bought? All that information are important in understanding the performance of a particular stock, right? And on last slide here, I put what any chart shows at the high level. One is strong upward uptrend. It also shows higher highs and higher lows. What do I mean by higher highs and higher lows? You see that the high here is slightly higher than this. The next one is higher than this. The next one is higher than this. The next one is higher than this, and it keeps going up. That is upward trend, right? And it shows occasional pullbacks, normal corrections in the short dips, profit-taking phases, consolidation zones. What do you mean by consolidation zones? This is where you see consolidation zone. In the second chart, you see here, this place is, yeah, it's consolidating. What does consolidation means? When we get to technical analysis, we discuss it. It also, there's a way you trade consolidation zone. There's a way you trade uptrend. There's a way you trade downtrend, right? So we look at that when we get under strategies, you know. So in terms of Zenith price movement, what's driving it generally is their strong earnings. Zenith is one of the strongest and well-run banks uh, in Nigeria. They have good reputation for paying high dividend, and they pay consistently. Like I said, since 2006, I went to check their records. They've always been paying. They've always been paying, so they will always pay. They will always pay. Some banks will not always pay, right? So if you are the type that wants some uh, cash payment every year, dividend is one stock, Zenith is one stock you want to have in your portfolio, and they have good macro factors, you know, and essentially put here that if you hold Zenith, you want to ride the trend up, you know, if you have enough volume, you can actually trade some of your Zenith to remove profits. If for those that need money, you don't need money, you just leave it and enjoy your dividend, right? And if you are risk averse, you might want to wait until when there's a pullback to 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 buy. It's just that as humans, when there's pullbacks, you might not have capital to buy at that time. Then you now miss the opportunity again. Okay, so that's all for this first session. Um, I don't know if you have one question. I can attend to one or two questions before we call it a day. I will share the recording for some of us that came later to listen to. So this is the first session. Next month we look at, I think we'll be going to fundamental analysis, before we move into technical analysis and all that. So that's all I have. Any question from the house? Any question, any comments? Just signify or unmute your mic and ask a question.
Okay. Look, I hear me.
Yes, I can hear you. Wally, go ahead. Good evening.
Okay, yeah, well done. Well, thanks for that. That was very insightful, actually. Okay, so I just want to ask a direct question. I know it's a bit around the bush. Zenith is going for about 110, 111.
Mm.
What do you advise? Do you advise to buy more at this point or to wait for a decline?
All right. Thank you for that question. Uh, First, it depends on your strategy. So let me use my strategy, for example. I am very dividend weighted. What that means is I set a target for myself as to how much I want to realize in dividend in a particular year. And Zenith is one of my top dividend stock. So I have a target of the number of shares I must buy this year. So I don't really uh, wait until when it dips to buy shares. I buy it because I know a good stock, a good fundamentally sound stock will always go up. It's doing 111 today. It will do 200 very soon. So I don't worry about it. It's a long-term stock for me. So I buy. Some, if you are not leaning towards dividend and you are very sure that you can keep your cash somewhere else, you might want to wait till when there is a correction. Usually after they pay dividend, stocks will come down, right? Come down. But from experience, Zenith doesn't come down too much before it starts to rally up again. So if you can be sure that you keep your money and that money will not evaporate or go into something else, you know, you might want to wait for a pullback. When that pullback will happen, I cannot say. Remember when Zenith fell to 54 around November last year here, right? If I was thinking that it would go to 30 something, it turned back, it started picking. Now, somebody that saw it here will feel like, I'm going to wait for another pullback. Yes, there was a small pullback here. I bet you that person will say, I will wait for that pullback again. And the stock keeps rising and keeps going. So for me, as a principle, if it's a dividend stock, I buy, right? If I meet it at the point that it's a pullback, I buy more. In fact, when it pulls back, I buy more to do what we call averaging down. Because when you buy it at 111, when it comes down to 72, you buy more. Your average will be around 80 something, right? So instead of waiting till when it's going to pull back, and you might not still be able to buy at that time, it is much better for any stock that is fundamentally sound to keep buying them and be averaging up or averaging down. That's a strategy for a fundamentally sound stock. So I will not say you should hold back. I will say you should keep buying. If it drops, buy more. If it drops, buy more. If it drops, buy more. Your average purchase at the end of the day will be lower than waiting for when it's 72 and you want to buy at that point. That would be my suggestion.
Yeah, thank you very much for that. Very clear.
All right. Damilola, you can go ahead, sir.
Hello, Coach. Good evening, and thank you so much for this insightful one. I must say this is the clearest of stock presentation I've listened to. And maybe my question might be coming earlier than maybe next month's session that will be going into the fundamentals. But I've also been trying to learn a few things around the fact that I've heard that usually when companies pay dividends, the market usually like maybe course correct after. So my question to you is that even though yes, we know that usually we are the chief decision maker of our stock, but do you have like about 3, 4, 5 stocks that you know that are looking at the antecedent and fundamentals that probably might pay dividends. I don't know, maybe they said it's April or May, uh, that will pay dividends around that time, and we can take advantage of saving towards the correction in price that would happen. I'm aware that maybe I'm not so sure whether it was MTN or so, but probably if you can just let us have an idea of a few stocks that probably will pay dividends and they would actually like maybe course correct. And then secondly, I also wanted to hear from you. What's your take around what's it called? Is it quarterly reports? Because, for example, I went into Dangote Sugar uh, not early this year, early February, and I think not long after, I realized that the stock actually went deeper than I bought. I think it went maybe like about 6 naira. And I was trying to research, and I learned that maybe market felt like maybe they said some stakeholders felt like maybe the quarter 4 performance wasn't so good. So in my head, I'm looking at okay, are there cycles we could watch out for so that we can strategically plan our decision, even though we know that prices will always come down. But I think that in retrospect, I felt like, okay, probably if I targeted maybe the end after the quarter 4 or after the quarterly report will come out to buy, maybe that will have been a better advice. So I just wanted to hear your take on those 2 points. Of course, I know we learn every day, and I'm actually here for the long term. So it will be good to hear your take on these 2 questions. Thank you.
All right. Thank you, Mr. Dami. Those are interesting questions, and those are some of the things we want to learn in these sessions. But since you have asked a question of the future session, let me just try to uh, attend to some of it. Let's start from the second one, which is cycles. When we get to technical analysis, you will see how you can understand the cycle of a company. Here I talked about having an high level review. If you go to investing.com, for instance, and you pick any stock and you back out on 1 year, or you back out on 2 years, on 3 years, you will see pattern. I wish I could launch a live chart for you now. You will see the pattern. You will see when they pay dividend and what happens to their stock, all right? Whether it's rally back up or it comes down. That begins to give you an understanding of how they behave. Every stock, including the all Nigeria share index, move in a cycle. All right. Every stock moves in a cycle. I understand Zenith behavior. For example, let me use Zenith because these are some of the stocks I've been watching for years. Zenith will always rally around January, February, March, because everybody's waiting for their dividend, for their result announcement. Most banks will announce their result around March, April. And because Zenith and GTB, they are top competitor when it comes to performance, right? Everybody's always waiting for it. And we have so much build confidence in Zenith that we know that they are going to announce a good result and pay good dividends. So people are coming in, people will be mopping it up. So that pattern has always been there. So if I want to buy more of Zenith, from November, I will start to buy Zenith. November, December, I start to buy Zenith. January, I'll keep buying. It will rally around March. It's something that we have seen year after year. After this session, I will try to do some of those analysis, maybe share it on the main group so that we can all see what was Zenith pattern in 2024, 2023, 2022, and 2021. If we do it like that for 5 years, chances are that next year the pattern is going to be the same, right? So we can always pick those stocks. So there are stocks that we know around September they're going to drop, right? So there are stocks like that. So it just requires us to do some bit of digging, looking at their trend and their values and map it out. It takes some effort, right? It takes some effort, but it's something that we can do. And I wanted to actually mention when I was doing this chart presentation that you can take advantage of AI. The investing in 21st century is better than it used to be, right? If you know the right prompt to ask chat GPT or Copilot, it's going to give you some of this analysis and this report. But again, I always say that people should be careful with what AI is churning out. You don't want to entrust your same way you don't entrust your life to chat GPT doctor. You don't want to just entrust your high-end cash to chat GPT. But it can give you some eye opener as to what this stock have been doing in the past few years. So certainly cycles can tell us of when to enter a particular market and when to exit. But again, experienced investors will tell you that time in the market is better than timing the market, right? Because you can be 99% correct and 1% wrong, and that 1% can wipe out all your investment, right? So I am always for a fundamentally sound stock, understand their trend and their performance. They know when best, like I said, for fundamentally sound stock, you will average down over time. You average down over time. But if you are trading a particular stock that, let's say this year you want to trade on a particular stock, you are not really expecting their dividend. That's when you want to know when best to enter, when best to exit. We talk about all that when we get to the technical phase. I will try to demystify the technical phase so that you know when to enter, when to exit, how to enter, how to exit, right? So the first question, that's the second question. First question is about dividend and cost correction. Almost all stocks, after they pay dividend, they will cost correct. Zenith will likely pay around April. We've always been receiving our dividend around April. Some banks will pay May. So usually April, May, June are like for cost correction. Now, because by the end of June, they will have been getting ready to audit their half-year record. For those that pay interim dividend, you will tend to see that their stock will peak a bit again in August, right? We pick a bit again in August, September. Then when you are getting to October, November, they might want to self-correct again. Then from January, when we are ending the year is ended in December, now they are closing their books and auditing, then they want to rally again. So those patterns are there for us to know. And we see them on the charts. When we get to more chart analysis, we will do more exercise in taking all this stock, right? Taking all this stock, we dissect them, look at the pattern, by looking at it, you yourself you can see that this thing is moving in a cycle now. Why is it coming down here? So for example, if I take Zenith, I can look at what happened in November here, even though I know what happened here. The market was reacting to the news around the capital gain tax in the new tax law. So the foreign investors were not happy, so they were pulling their funds until government came in and said, okay, they're going to do something about it. That was an opportunity, right? But if you see that it has been coming down gradually from here, so we can look at what happens around November for the past 5 years for Zenith, right? You can look at what happens in January for the past 5 years. You will see that the pattern will look almost the same. So I can bet you this year, if Zenith is around 100 naira by November this year, be sure that you're going to 150 or 180 by March next year. So you want to wait for those seasons to accumulate more of those songs shares. So we do more of that when we get to other sessions. I don't know if I tried to attempt to answer your question.
Yes, thanks. That was very clear.
We do more of those exercises to get us familiar with all this strengthening. Okay, let me call it a day. Thank you for making our time. I've promised that we are going to start this session. It's going to get better as we move on. There are still more grounds to cover. This is just like introducing us generally to what stock market is, so that when we engage other people or we listen to news or we read report, then we can be a little more at home with what we are seeing, the terminologies and the market as a whole. Thank you all. I will make recording available for all of us to review and others to listen to. Let's have a profitable week. Thank you.
Thank you very much.
Thank you, Madam Fumi. Thank you so much.
Thank you very much, Coach. Thank you. We are very grateful.
You're welcome, Madam. Yeah.
Bye.
Thank you. Thank you. God bless you. More grace to your elbow.
Thank you, bro. Thank you for making our time.